My name is John DiForte, and I'm going to do a series of short YouTubes on personal insurance. My objective is to provide the viewer with enough information about personal insurance so that they can make an enlightened choice about the coverages which best suit them. If your insurance is important to you, sadly you can't name your own price, and you can't do it in 15 minutes. The topics I'm going to discuss are private passenger auto, homeowners, and that includes condos, renters, and co-ops, boats, floaters for high-value items such as jewelry and furs. I'm also going to touch on flood insurance, the personal umbrella, long-term health care, and life insurance. I'm going to explain the basic principles of the insurance mechanism and the primary tenets of personal risk management. For each of the lines of business I'm going to cover, who is insured, what is insured, the insuring agreement, and the policy exclusions. I'll be rounding out each policy segment with those overlooked coverages that are critical to a well-balanced insurance portfolio. Insurance is a complicated product that I'm going to attempt to simplify. Insurance is primarily sold on price, and it shouldn't be. Most insurance policies have gaps in coverages that can lead to significant financial loss. These gaps can easily be closed, and usually at a relatively low price. Insurance is a financial, economic, and contractual mechanism that transfers the risk of significant financial loss from the individual to the population as a whole. We do it using the profit model because it allocates resources in the most efficient manner. The insurance contract affords us the legal format, while the law of large numbers provides the mathematical template. Modern insurance has evolved into two camps: risk transfer and risk funding. The risk of loss can either be catastrophic or predictable. Risk transfer. We transfer risk when the consequences of loss are so significant it can no longer be sustained by the individual. Hurricane Sandy would be an example of a catastrophe whose scope requires the participation of society as a whole. Risk funding. I like to refer to this as paying for your losses on the installment plan. The risk of loss is certain. What is uncertain is the timing. The function of the insurer is to provide risk financing and claims management. Think of a broken windshield. Sooner or later it's going to happen, and when it does, do you have the $1,000 to fix it? In essence, you are paying a small amount of money in advance for a loss that is predictable. A history lesson. Western insurance starts in a small coffee house on Tower Street. Ship owners would meet there concerned about the perils of the sea. They pooled their money, and when a ship did not return, the owner of that vessel would be made whole by the pool. I am your surety, and you are mine. The first reciprocal insurance company was born, and we now call it Lloyd's of London. Without insurance, the economy grinds to a halt. Industry does not develop new products or make investments if they can't hedge or mitigate their risk. Banks do not make loans to prospective buyers of homes and automobiles if they can't secure their investment. Insurance is important, and if you're a person of substance, it should be important to you.